Welcome to LaTour Retirement Talk. I'm your co-host, Tony Shore, and I am really pumped up about today's show, Jim, because you have brought us a very special guest. First time for this guest on the show, and this is a huge get. So,
It is.
Jim Margraf, our host of the show. Jim, tell our listeners and viewers why today is going to be so exciting.
Well, Tony, it's always a great time when we get to bring one of the portfolio managers on the show from Gradient Investments. As many people know, we use Gradient Investments as a third-party platform. They create and manage the portfolios that we use when we're helping out our clients and creating the financial plans for them. And so it's always a great thing to bring on one of the portfolio managers and get the perspective straight from them. So I've got Lisa Schreiber here with us. Lisa, welcome.
Thank you so much for having me today. I'm excited.
It's great to have you. Thanks for coming on with us here. So it's my understanding that previous to being with Gradient, you worked as a private client advisor for a bank.
That's right.
Correct?
Yep. Mm-hmm.
Okay.
Yep.
In Austria.
That is right. Yep.
Okay. So you were born and raised in Austria then?
I was. The first 29 years of my life, I was born and raised in Austria. Exactly.
Okay. All right. So there you worked with clients for both investment and insurance for high net worth clients.
That's right. So I worked in a middle-sized bank
Okay.
for high net worth clients, and I did mainly insurance and investment consultation for them.
Okay.
Yep. So yeah, overall in the financial industry for about 10 years now. Mm-hmm.
Oh, nice. So for those that don't know, here at LaTour, we use, as I said before, Gradient Investments because they create and manage the portfolios that we use. And the question oftentimes comes up, well, why do you use Gradient Investments as opposed to someone like Fidelity or Vanguard or BlackRock or one of those? And, when you're looking for a company that creates the portfolios for you, obviously you want a company that's large enough to create a variety of portfolios. But the issue is if you're using Vanguard or Fidelity and you have a question about a portfolio and you would like to talk to somebody more about, why is this portfolio behaving the way it is in the market and someone to describe it for you, you don't really have access to anyone to give you that kind of information. You can read what they print out about it or what they have online about it. But with Gradient Investments, not only are they large enough to give us the variety that we need, but they're also small enough to give us the attention, the personalized attention that we need. So we actually get to talk to portfolio managers from time to time. So that's why we were able to get Lisa and have you on the show with us today. I've sat down with Keith and Tyler and a couple of the others over the years. And so thanks for joining us. Thanks again for joining us today.
Yeah, thank you very much. And again, that's very, very special for me too, because as you mentioned that you and we are available for clients and for you as the advisor. I mean, that's what I like most about working at Gradient Investments, because it gives me personally the best out of both worlds, right? I can manage and do the research and analysis, which I like, but I'm not only behind the screens, right? I'm also sometimes can join shows like yours today, or sometimes fly out to events and talk to our clients that we serve, which is always very special to me.
Yeah, I would have to say the personal attention that we're able to get, especially when we have those questions or when clients have those questions, has proved invaluable for us as we're putting plans together and helping our clients, especially those that are making that transition from their working life into retirement. How do they reposition the funds and all the questions that come along with that whole process? So if you would, could you tell us a little bit about yourself and why the financial services industry? Why investing?
So I started my career like in the beginning. I was in the hospitality sector for a while. I worked for a very high-end wellness hotel in the mountains of Tyrol in Austria. And then I kind of was also involved a little bit in the accounting and reservations, so in the back office and actual hotel management side of it. And I found my love for finances there. But I'm like, okay, I haven't arrived completely. I want to do more in the financial industry as specifically. And then I switched over to a bank, and I studied financial management and controlling and accounting. And again, I started out as an advisor, which is great, because then I really learned the picks and shovel, what it needs in advising clients in their transition to retirement, and what it needs to, be there for them in different areas of their lives. And I found my love for the actual investment management and the research and analysis. And I was like, okay, this is my place to be.
Okay.
And so I'm now with Gradient Investment, and I started as an investment analyst 3 years ago, and now I'm an associate portfolio manager. And like I said before, I have now the best of both worlds, right? I'm deep in the analysis and research all day, every day of the markets, but still being able to have contact and relationships with our advisors and our clients that we ultimately serve, which is very special for me. So have the best out of both worlds, I would say.
Very nice. Very nice. So, they're at Gradient Investments. Which of the portfolios would you are the ones that you are most involved with?
So I have a wide variety, I would say. So when it comes to overall fixed income, I manage our stable value portfolio, which is more our money market equivalent portfolio,
Mhm.
than our laddered income, which is our bond ladder portfolio. And when it comes to a little bit more smaller portfolio that serve very distinct client needs and interests, there I manage the socially responsible portfolio. And then
Okay.
another one that we just created in April, that is brand new, which is our Christian values portfolio that I'm involved in and I'm leading. And also on the structured note side, I'm managing our buffered outcomes portfolio. And I'm
Okay.
also involved in the deals that we have and the offerings in the structured notes that we have every month. And
Okay.
last but not least, I manage our precious metals portfolio.
Okay. Nice. So, if you would, could you go? I've actually had some recent questions about the Christian values portfolio,
Mhm.
obviously because that's one of our newer offerings. Could you describe that one a little bit for us?
Mhm. So it's an ETF-based portfolio. We use ETFs from Eventide, for Inspire, and Global X, for example. That's the issuers that we use at the moment, and they have different screen when it comes to Christian values and certain industries that they exclude and certain industry that they want to put emphasis to.
Sure.
A very interesting portfolio, and we actually introduced it because we had more advisor feedback
Hmm.
that wanted to have that in their offering. So it's very complementary to that. And we can basically invest globally. So it can be the US, it can be international, emerging markets, wherever we see opportunities, but also in small caps, for example, or large cap US. So we can literally go the broad spectrum of the whole market, but always managed with Christian values in aspects in mind.
Okay. Yeah, I think that's something that resonates with a lot of people because
Mhm.
we don't like the way we see companies spending their money. And I know, here in Southwest Missouri, we're in, I guess you'd call us the Bible Belt here. Uh, I think I drive past like 4 churches in before I get on the highway. So there's a lot of that type of value
Mhm.
here in especially here in Springfield
Mhm.
and in the surrounding areas. So thanks for that. So 2026 has been a year with a lot of headlines.
Yep.
There's a lot of things going on, both domestically and internationally, that have affected the market. I mean, we've got we were anticipating rate cuts from the Fed as we started the year, and then we get down a little bit, and hey, now we've got something going on over there with Iran and the shipments of oil and other things going through the Strait of Hormuz getting closed down, and all of that going on. We've got all the stuff with AI. Could you give us a little bit of kind of a recap of what the things that you were paying most attention to and how you saw it affect the market and the portfolios of Gradient Investments?
Yeah, sure. I mean, it was certainly a great year, a great first half year for overall markets. I mean, when we just look at the overall indices, no matter if it's international or the US, most are in the green, right? The S&P 500 is up nearly 10% as of last month. And we have small caps nearly up 22%. So they are outperforming by a wide margin. We haven't seen that in a while before 2025. For over a decade, they were underperforming. International emerging markets and international, they were also doing great. So everything looks good on the surface, but there was a lot going on underneath, right? Which certainly makes my job very interesting. And there's always concern, right, that the market has to work through. For example, we had, and you just mentioned it, we had the US-Iran conflict break out end of February this year. Obviously, that accounted for nearly a 10% correction in the overall market in the US.
Right.
So we had oil prices spike then. I mean, from below 70 going up as high as over $120 per barrel. That certainly is a spike that is impacting a lot of different areas of the market, but also people, right? I mean, we see that at the gas station every day. It's still more expensive than we would like to see. It kind of keeps people from spending in other areas when a lot of the discretionary spend needs to go through the basic needs of just driving somewhere or driving to work.
Right.
So that certainly was a big thing. And it also is increasing or putting upward pressure on inflation, right? I mean, we saw inflation was still above the magic 2% where the Fed would like to have us. It was still higher above that, but it was not as much of a worry child. Obviously, higher oil prices not only flowing into gas, like I said, but also into everything that we use every single day.
Sure.
And obviously, where the conflict is in Iran, there's a very important supply bottleneck for the global oil supply. So that certainly has impacted it very much. And that was a big news and big headlines for the markets in the first half year. But also in another area that was very much in the news and still is and will still be with us for a while is the whole AI infrastructure build out, right? When we think about AI and the hyperscalers and all of that, that certainly continue to be with us, but in a different way. So we have a different shift of how AI impacts different areas of the market at the moment. When we think about the last couple of years, the Magnificent Seven, so to speak, right? The largest 7 companies in the US and in the world, a lot of them hyperscalers are involved in the AI build out and actually building all that infrastructure that we need for that. We're driving the markets, right? Have a huge weight in the S&P 500s, and we're basically solely driving returns. Well, that now has changed. And coming into the year, we talked a lot about the market broadening out. So we still see that happening. And we had earlier this year, we had software, for example, as a subsector of tech selling off as new AI models came out. Now we had chip stocks rallying, right? While the Magnificent Seven stocks are more lagging compared to the prior years leading. So that all of that different shifting narrative and broadening out was a huge theme of the first half year. But I think overall, I welcome that very much because it means it sets us up for broader and more balanced returns and for our clients, right? Where in more areas of the market, more industries are participating in growth and not just a handful of companies. So it's a lot healthier now, but certainly very interesting and shifting expectations.
Yeah, and as you were talking there, I was thinking about the conflict with Iran and the supply of oil. It's a pretty decent percentage of the world's oil that flows through the Strait of Hormuz, and the oil doesn't come here, and most of that oil goes to China and that part of the world. But the issue is that part of the world has become the world's manufacturer, if you will, and so how many of the goods that we buy every day are made from plastic, and all plastic comes from oil? I mean, I'm sitting here in front of a microphone stand, and there's plastic, right here in front of me, and the computer in front of me has got a lot of plastic, mostly all plastic parts, and that most of that is made in that part of the world. So, you can see where you mentioned the pressures with the price of oil being a upward pressure on inflation. That's another factor for the cost of goods is just the that restriction on the flow of oil over there.
Absolutely.
So, that's a big thing. And,
Huge.
and still today, we're still, there's that conflict is still going on.
Yeah, in fact, it looked like it was getting better, and now it's worse again. So it seems to change regularly. And I imagine, Lisa, that's something you guys really have to keep an eye on, because oil affects everything, right?
Absolutely. I mean, as you all said, it goes into everything that we use every day, and even into things that we are not maybe thinking of right now, right? It also goes into the food supply, because when we think it's what comes from that area is not only oil, it's a lot of fertilizers too. Actually, the majority of the world's fertilizers come from that region, and that all goes into the food supply, what farmers use for growing our crops and all of that, and then the transportation costs and all of that. So that is certainly something that we keep a close eye on, because it can obviously strain consumers' purses, right? And increase inflation. And that, to your point, and Jim, you mentioned that in the beginning, when you said, okay, interest rate expectations have shifted dramatically, right? And that also feeds into that, and is the majority, or the reason why they have shifted so dramatically. Because when we came into the year, things were good. Inflation was not really the worry child anymore. We had more worrying of the labor market and kind of jobs creation. That has eased since then. And then the consensus was, okay, we expect about 2 to 3 rate cuts this year to kind of support the labor market. Inflation is still not completely good, but moving into the right direction. That should be good. And then the conflict broke out. Oil, as I said, put some upward pressure. We saw that in the last couple of inflation reports. Well, that shifts the narrative for the Federal Reserve, if they maybe have to hike rates, right, to tame inflation back down to normal. And we shifted from 2 to 3 rate cuts to maybe 1 or 2 rate hikes potentially until the end of the year. We don't think that this is going to happen necessarily right now. I mean, we saw some easing in oil over the month of June, right? We heard some negotiations happening. Now we are a little bit back again at attacks and exchanging hostilities. But we saw with the latest inflation report that we received this week, that oil prices or inflation pressures are easing, or starting to ease right away, when we see some oil prices that are coming back to normal levels, around like the $70 that we saw before the war. So I think I do not see cuts either, but I think the Federal Reserve will be very careful, and then at least pausing for the rest of the year. But certainly at the moment, it does not look like too many rate cuts, which is certainly also a tailwind for the market overall.
Right. So just a quick recap on that. You're thinking that not only are we not going to see any rate cuts, but you don't really see us having any rate hikes either.
No, I'm not in the camp yet for rate hikes. I think there need to be very, very careful. Again, the labor market is in a better shape than it was end of last year, which was the narrative why the Federal Reserve might need to cut rates. I think that is off the table now. But still, we have, and it all depends on the Middle East, basically, of how we are moving there. How fast do we have a resolvement there? I mean, we are in 4 months now, right, which is longer than many have expected. But again, if there is an easing, then it obviously should put an ease to inflation as well, and with the Fed not needing to hike at all, maybe for this year. But I think certainly a pause will be necessary.
Yeah, unfortunately, it's amazing how for our economy, what happens on the other side of the world, the little things that are over there can affect it. Like the fact that Iran has these cheap drones that are carrying a bomb or a missile, and they're hard to defend against. And that's an issue. And for us to be able to stop that, from in the strait, from any of those types of drones being able to do anything, that's it's interesting to me how interconnected we are with every other part of the world all around. And you wonder the concepts that were floated decades ago about being this connected world, this global worldview. Now we're sitting here wondering, well, how beneficial is some of these other things affecting us from the other parts of the world? So, Yeah. So another thing that you've mentioned here is the small caps have really surged.
Hmm.
And that's been kind of a news headline on the market side of things. And what are you seeing there with the small caps? Is it pretty broad sector in the small caps, or is it more narrow?
Yeah. So it started basically last year in 2025, small caps really starting to
Hmm.
take off again. Before that, again, like for much of the decade, that hasn't happened sustainably, which is interesting because obviously a little bit lower or a more pronounced interest rate environment, the lower interest rate environment is better specifically for small caps because smaller companies need more funding, right?
Right.
So that is certainly a big influence there. But also when we see of what small cap stocks outperform actually, then we see again a lot of this whole AI trade taking shape here in the smaller areas because most of the returns come from small cap stocks that are exposed to the AI infrastructure built out. So I can see that going forward, continuing. But again, we need to be careful because the broad small cap, for example, the Russell 2000 is our index for small cap, US
Hmm.
small cap stocks. Then we still have to be a little bit careful here of how we view it because a lot of these companies, about 40, more than 40%, are not profitable, right? And the others are
Okay.
actually driving returns, and most of them driving returns are some in some way, shape, or form involved in the AI infrastructure built out in the AI trade at the moment.
Okay. So with the whole AI world, I know there's a lot of promises that are being made out there, but there's a lot of concerns as well. I mean, because it's going to need it in order for us to get where the promises are telling us we can get to, we're going to need a lot of power. We're going
Mhm.
to need, and then from that power, now we need water for the cooling of these power plants and all the store data storage to the data centers and all of those things. I mean, we had the circumstance that happened in Utah where was it Utah or was it I forget where it was where they didn't want to build the size of the facility. The residents objected to it. You
Yeah.
know, so those are some concerns. And so, how do we manage this going forward? I mean, as far as from the investment world, we're looking at okay, so who is generating the power, and there's things going on there.
Mhm. So we certainly have to keep an eye on that because, as you said, there is more protests happening about where these data centers can be built or where
Right.
residents want them to be built. For example, New York just imposed a ban on building huge data centers for these things for a year and kind of observing okay what kind of strain does that put on on the energy grid, right? And
Hmm.
how does that impact the prices for residents there? So that is certainly something that we have to keep a close eye on. But overall, I mean, this is the hyperscalers, like I talked before, they are putting $700 billion in capital expenditures to the build out of all of this sector, which is huge.
Wow.
This is amazing, and it kind of grew from 450 billion last year, and it should pass the 1 trillion next year. So that is huge numbers and a huge opportunity too, and that is also what we are seeing with the broadening out. And the Max 7,
Okay.
again, the actual spenders of this infrastructure are lagging year to date because that's a lot of spend, right? And investors are getting
Right.
a little bit wary. Is like, do we really see these returns anytime soon, or do we have to wait longer for actually seeing some revenue from that spend, right?
Sure.
All of that spend is another company's earnings and a revenue, and that's
True.
what we're seeing with the broadening out, right? And with more companies participating from that spend. For example, chip stocks,
Hmm.
huge rally the last couple of weeks, but also the actual picks and shovel, right? When we think of about more boring areas of the market, if you will, cement companies, companies that produce all the electrical connectors that are needed to go into these data centers to build them, right? So all of this
Wow.
infrastructure. So we see a very broadening out, more areas of the
Hmm.
market participating in that build out. And then obviously when we move into the next phase here, which I think this is already the next phase, right? More areas and more infrastructure is participating, which gives us more more balanced returns, because not only a handful of companies are participating and actually creating returns, but more. And then also when we go into the even next phase is like, okay, to actually put this compute to use. And every industry will be affected by that. For example, healthcare, and we think about med tech companies, right? There's huge opportunities. And these, as the build out continues, we are moving from infrastructure, from actually putting all of these picks and shovels to the ground to build all of these data centers, to actually using it and creating that revenue and that beneficiaries going forward. So I think we can see a little bit more broadening out as we move through all of these different phases of the AI build out. And that certainly gives us a little bit more opportunities, but also a little bit more volatility. And we saw that, right? This year, in the chips, stocks, for example, strong momentum there, and then also huge sell-offs, right? Because their leadership is rotating very fast. Obviously, there is some concern there if all of that spend is paying off, and where does it pay off, and what areas of the industry. So there's certainly a lot of opportunities, but also some heightened volatility there for sure.
Yeah, there is. And so, as you're talking there, I'm thinking, so, as we're looking forward, these are things we're paying attention to. What's happening in the AI? What's happening in regulations, even as we can see in New York. So, we don't think about, you think about the volatility risk and things like that to our portfolios, but we also have legislative risk, because what if a particular industry is suddenly affected by, a state or maybe even a national moratorium on building, like New York just did on the data center. So these are all things that go into, how is a portfolio managed and paying attention to the companies. And, you enjoy doing the analysis. I'm happy for that. There's people like you in the world that enjoy doing the analysis of those kinds of things.
So the rest of us don't have to.
Exactly. I enjoy listening to you, and it's helpful. And, this is why, I like having someone like you on the show, because as I'm sitting down with clients, they want to know, okay, what's happening with my portfolio? Who's managing this? and what's going on here? And so, seeing the perspective of a portfolio manager, paying attention and getting into the weeds of the different sectors, the different companies, and how they're affected by what's going on. You can tell just from what you've been saying, you definitely have your finger on the pulse, if you will. So thank you for all that you do at Gradient Investments.
Yeah, you're very welcome.
Yeah, a lot of great information in today's show. So I know you can pick up the phone and talk to Lisa on behalf of your clients, or if they come in and have a question, or if our listeners and viewers have a question, you can get her on the phone to answer these questions. And you have direct contact with these portfolio managers, Jim, which I think is fantastic. Now, before we go, I know a lot of our listeners might have questions, or might say, hey, give me a second opinion where I'm at. Are my investments where they should be? Am I set for the future? How can they do that?
So, Tony, very easy. Just give us a call, 417-641-3497. Also, check out our website at LaTourAsset.com. Give us a call, schedule an appointment. We'd be more than happy to talk to you.
All right. Well, thank you to our very special guest, Lisa Schreiber, portfolio manager at Gradient Investments, and our host, the man with the plan, Jim Margraf. Listeners and viewers, that does it for today's episode of LaTour Retirement Talk with our host, Jim Margraf.